Assalamualaikum and a very good day to Dr. Suhaiza. We are from Group 5 and in this slide we will present about the two sets of past year exam questions.
Our team is consisting of 5 members. This is the distribution of the tasks for our group.
And in set 1, we managed to find several key concepts including credit policy evaluation, the cash conversion cycle, age schedule of account receivables, actions to improve collection process, and the 5 C's framework. For the first part, which is to evaluate the proposal from Hutang Sendirian Berhad and advise whether it is financially beneficial for Ehsan Berhad. To solve part A, our procedure follow a logical flow, which is step 1 is to calculate the current state. We find the current average collection period, which is 10 days over the limit, so 45 days, and the current financing cost of those receivables. Step 2 is to calculate the proposed state. We determine the new sales and the new SCP. And then we find out that 40% of customer pays in 10 days, while 60% still take 45 days. Step 3 is to quantify the cost of the change, including the 2% discount given to those early payers and the new administrative costs, which is 2% of total sales. Step 4, which is the final step, is to compare the two state, which is the current state and the proposed state. We subtract all the new costs from the incremental profit. If the result is positive, Ehsan Berhad should proceed. For part B, we look at how Ehsan Berhad decides who actually gets credit. Here, we use the 5 C's of credit framework to assess a potential customer's creditworthiness, including character, capacity, capital, collateral, and conditions. We gather financial statements, bank references, and reports from credit agencies, and then we apply the 5 C's to assign a credit score or limit to the customer to minimize the risk of bad debts. For part C, we calculate the cash conversion cycle, the procedure including finding the inventory period. As stated in the question, the inventory period is half of the receivable period. Second, we will identify the payable period, which is given as 30 days. And then we apply the formula, which is by adding the inventory days and receivable days, and then subtract the payable days. We then compare the current CCC against the new CCC to see how many days of financing we have saved. In part D, which is the last part, we analyze the aging schedule. This is a report that categorizes account receivable based on how long an invoice has been outstanding. An aging schedule helps us spot trends. If the over 90 days category is growing, it is a red flag that our collection department is struggling or customers are facing financial distress. We want the majority of our receivables to stay in the 0 to 30 days bracket to keep the cash conversion cycle short. The actions to improve collections including strengthen the credit control and follow-up procedures by implementing stricter credit terms, set credit limit, and conduct regular follow-ups such as emails and phone calls. Second is to introduce incentives and penalties. We offer early payment discount to encourage prompt settlement and impose late payment penalties to discourage delayed payments.
Question 2. The key concepts that we identified are residual dividend policy, constant payout ratio policy, dividend per share, and Modigliani and Miller's dividend irrelevance theory. For question A, we want to assess whether ABC Berhad can finance its capital expenditure of 50 million ringgit without issuing new equity based on the proposed dividend per share of 1 ringgit 20 cent. So ABC Berhad is proposing a dividend per share of 1 ringgit 20 cent. We multiply this by the 30 million outstanding shares. The total dividend payment comes to 36 million ringgit. Next, we need to know how much the retained earnings available after the company pay the dividend of 36 million ringgit. We minus the net income of 60 million with the dividend payment 36 million. After subtracting, the company is only left with 24 million ringgit in retained earnings. Next, we need to know the required equity financing. So, we need to multiply the equity ratio, which is 0.6, with the planned capital expenditure 50 million ringgit. This equal to 30 million ringgit. Since the 24 million ringgit in retained earnings is less than the 30 million ringgit required for their investment, the conclusion is clear. ABC Berhad cannot finance its capital expenditure without issuing new equity, as the firm has a lower retained earnings compared to the required equity financing. 4B, the question asks to calculate the new dividend per share using the constant dividend payout ratio of 60%. First, we need to calculate the total dividend payment, which is net income 60 million ringgit times 0.6. It equals to 36 million ringgit. To get the dividend per share, total dividend payment over ordinary shares outstanding, which is 36 million ringgit over 30 million units, resulting in dividend per share of 1 ringgit 20 cent. The question also asks for two benefits to this approach. The first one is dividend fluctuate directly with net income, which can be seen as a fair way to distribute a fixed proportion of the company's earnings. The second one is signaling. A higher dividends in a good year signals strong performance to the market, which shows management confidence. For C, we need to calculate the dividend per share if the company adopt a residual dividend policy. Under this model, the company will prioritize its investment needs first. The planned capital expenditure is 50 million ringgit, the retained earning available is 60 million ringgit, and then to get the equity needed, 60%, which is the equity ratio, times with the planned capital expenditure, 50 million ringgit. Then, the dividend need to pay is retained earning 60 million ringgit minus with the equity needed 30 million ringgit. To get the dividend per share, dividend payment 30 million over 30 million units of share outstanding, the answer will equal to 1 ringgit per share. The question also want to know the implications of this policy change to shareholders. First is the advantage. Dividends are linked to the company's investment needs. Under this residual dividend policy, company uses profits to fund investment first. This helps support growth and can increase the company's value, which will benefit shareholders in the long term. Second, the advantage is less need for new shares. Using retained earnings reduces the need to issue new shares. This prevents share dilution and allows shareholders to keep their ownership and control. The third one is disadvantage, which is negative signal to the investor. Lower or no dividends may be seen as a sign of poor performance of the company, even if the profits are used for the investment. This can reduce investors' confidence and lower the share price in the short term. For D, we need to critically assess the relevance of Modigliani and Miller's dividend irrelevance theory in the context of emerging markets like Malaysia, especially where information asymmetry, signaling, and investor preferences play a key role. The answer is, in an emerging market like Malaysia, the Modigliani and Miller's dividend irrelevance theory works more as a theoretical benchmark than a practical reality. They say that the company's value depends only on its investment decision, not on whether it pays dividends. However, this idea assumes a perfect market, which does not exist in Malaysia. In Malaysia, there is a lot of information asymmetry. This means managers usually know much more about the company's future than the ordinary investors. Because of this, dividends became an important signal to investors. When a company increases its dividend, investors often see it as a strong sign that the company expects stable and sustainable profits in the future. As a result, share prices often react immediately. This is clearly against the Modigliani and Miller's theory that says dividend changes should not affect a company's value. Investor preferences also important in Malaysia. Many investors depend on regular dividend income to meet their own payment needs. Modigliani and Miller suggest that the investors to create their own cash by selling shares. But in Malaysia, this is not practical as it involves transaction costs. That is why investors prefer to receive cash dividends directly. To conclude, while Modigliani and Miller's theory provides a benchmark, in emerging markets like Malaysia, dividend policy is important. Companies must carefully balance the investment needs, shareholder expectations, and signaling effect, as dividends influence both investors' perceptions and share price.
Alright, for question 3, we are looking at the proposed merger between Satria Berhad and Tegas Sendirian Berhad. Satria is a listed manufacturing company, while Tegas is a private technology company. The acquisition will be carried out through a stock swap transaction, where Satria offers 1.2 of its own shares for every one Tegas share. In analyzing this question, we will focus on three key areas. First, stock swap transaction. We'll focus on how the stock swap transaction in merger acquisition will affect the earning per share EPS of Satria Berhad shareholders. Second, tax losses carry forward and tax saving. We'll focus on the tax saving that arise from the gas accumulated tax losses. And third, we'll focus on the defensive strategies that the gas could use if it faces a hostile takeover. So let's go through this step by step. Let's briefly compare the key financial figures of Satria Berhad and Tegas Sendirian Berhad by extracting information from the question before the merger. This will help us to understand the question better. First, if we look at the earning available for common stock, Satria Berhad earned 25 million ringgit and Tegas Sendirian Berhad earned 8 million ringgit. So we can immediately see that Satria is larger and more profitable company. Next, in terms of share outstanding, Satria has 10 million shares. Meanwhile, Tegas has 4 million shares. Now, we divide earning by the number of shares, so we get earning per share or EPS. Satria EPS is 2 ringgit 50 cent. Tegas EPS is 2 ringgit. For market per share, only Satria has a listed market price, which is 30 ringgit per share. Finally, Satria price earning ratio is 12 times. This means investors are currently paying 12 ringgit for every 1 ringgit of earning generated by Satria. So overall, this table gives us a clear financial snapshot of both companies. Before we calculate EPS, we must determine how many new shares Satria needs to issue. Tegas has 4 million shares. For every Tegas share, Satria will give 1.2 shares. So, 4 million times 1.2. We will get 4.8 million new Satria share is issued. After the merger, Satria existing share will be 10 million and we plus with the new share issue is 4.8 million. So the total share is equal to 14.8 million shares. Now, let's proceed to calculate the combined earning after the merger. Let's look at the Satria net income, which is 25 million ringgit, and Tegas net income, which is 8 million ringgit. So the total of both company is 33 million ringgit. The merger also create estimated synergy of 5 million ringgit per year. After deducting tax at 24%, the net synergy benefit is 5 million ringgit. We multiply with the tax, which is 24%, we will get the corporate tax rate amount is 1.2 million ringgit. To achieve net synergy benefit, the estimated synergy before tax, which is 5 million ringgit, must be deducted with the corporate tax rate, which is 1.2 million. So, we will get the amount is 3.8 million ringgit for the net synergy benefit. So, the total post-merger income becomes 33 million ringgit plus 3.8 million ringgit. So, the total will amounted to 36.8 million ringgit. Now, we do the EPS comparison by divide the total net income of Satria and Tegas after the merger, which is 36.8 million ringgit with the total number of shares 40.8 million shares. That give a new EPS of 2 ringgit 49 cent. So, when we compare to the original EPS of 2 ringgit 50 cent, there is a very small dilution of just 1 cent. Although Satria Berhad experiences minor short-term EPS dilution, the merger is still justified due to: first, they can achieve the synergy; second, market expansion; and third, long-term growth potential. Next, we assess whether Tegas shareholders are receiving a premium. Satria share price is RM30. Since Tegas shareholder receive 1.2 shares, the value offered per Tegas share is 1.2 multiplied by RM30, amounted to RM36. Tegas EPS is RM2, so the implied price earning ratio is RM36 divided by RM2, which is 18 times. This indicates Tegas shareholders are being rewarded with a premium valuation, which helps encourage the acceptance of the deal. Question 3b asks to estimate the potential tax saving from utilizing Tegas and Berhad tax loss carry forward, and we have to discuss how this saving will impact the net income of the merged company. Tegas has an accumulated tax loss carry forward of RM12 million. With a tax rate of 24%, this will create a tax saving of 2.88 million. How do we derive to this figure? 12 million multiplied with 24%. So we will get the amount of 2.88 million. How the saving of tax will impact the net income of the merged company? So the first impact, if the Satria will get to reduce its tax payable. Second, they will increase post-merger net income. And third is improve the cash flows and the shareholder values. Moving to the next question, question 3C asks us to propose and explain three defensive strategies that the Gassender Berhad could adopt to protect itself from a hostile takeover attempt. If the gas becomes a target for a hostile takeover, it can adopt three defensive strategies. First is white knight strategies. The gas syndrome Berhad may find acquirer that is more favorable terms to acquire the company, such as Satria Berhad, to protect the management from a hostile bidder. Second is poison pill. The gas can issue new securities or right that make an acquisition more expensive or unattractive to the acquirer. This is to discouraging any takeover attempt. Third is greenmail strategy. Tegas Sdn Berhad may buy or repurchase a large block of its own stock at premium to end a hostile takeover. For question 4, we shift our focus to hybrid and derivative financial instrument. Emirat Berhad is a public listed manufacturing company that is currently planning to expand its operation. To finance the expansion, the management is evaluating the financial instrument including convertible bonds, stock purchase warrant, and option. We will also look at the conversion value, conversion premium, and the risk return trade-off from the both of issuer and the investor perspective. For question 2A, they ask us to explain the key characteristics of convertible bonds, option, and stock purchase warrant. We also need to highlight one key differences between stock purchase warrant and call option. Let's begin with convertible bonds. The key characteristic of convertible bond is it is a hybrid security. They pay fixed coupon interest. The holder also has the right to convert the bond into ordinary shares at a fixed conversion ratio. The conversion features provide the purchaser with the possibility of becoming shareholder on a favorable terms. Because investors receive this additional benefit, convertible bonds usually carry a lower interest rate than ordinary or straight bonds. Other hybrid security is stock purchase warrant. It is a long-term hybrid security that gives the holder the right to buy company shares at a fixed price. Warrant provide an injection of additional equity capital for the firm. Warrant have long lifespan where its offer lasts up to 10 years. And importantly, warrant are detachable, meaning they can be traded separately from the bond. As an example, the bondholder does not require underlying security to exercise the warrant. Moving on to the next is option. Unlike the convertible bonds and stock purchase warrant, options are one of example of derivative securities. Option has two types, a call option and a put option. A call option gives the right to buy shares on or before specified future date at a stated price. Unlike stock purchase warrant, call options are short-term maturity period which lasted to 9 months. Call option is most valuable for investor when the strike price is below the market price. A put option gives the right to sell shares or before a specified future date. It becomes more valuable when investors expect price to fall in the future. Although both of stock purchase warrant and call option allow investors to buy shares in the future, the key differences lies in the maturity period. Stock purchase warrant are long-term instrument. Call option are short-term instrument. Question 4b asks us to calculate the conversion value. The bond convert into 160 shares and the current share price is ringgit. So 160 share we multiply with the ringgit equal to 960 ringgit conversion value. Since the bond's face value is 1000 ringgit, the conversion premium is face value minus the conversion value. 1000 ringgit will minus with 960 ringgit. We will get the 40 ringgit. The premium represents the extra amount that investors pay for the conversion privilege. Since the conversion value 960 ringgit is lower than the face value 1000 ringgit, the bonds are not favorable for the investor. The potential investor might hold the coupon interest rate at 4%. If the conversion exercised now, it will result loss in 40 ringgit. Question 4c assumes that the investor anticipates that Emerald Berhad share price will increase to RM7 within 3 months. Let's do comparison between call option and stock purchase warrant if the price rises. First, we look at the cost premium of the call option. It's stated in the question that the call option with a strike price of RM6 and a 3-month maturity is trading at 55 cents. Meanwhile, for the stock purchase warrant which allow the holder to buy Emerald share at an exercise price of RM20, is currently trading at 70 cents and will expire in 2 years. By doing the table of comparison, we can see the differences better to determine which is the best financial instrument for the investor. Summarized from the table, the call option costs 55 cents and lasts for 3 months. If the share price rises to RM7, the potential profit per share is 45 cents after deducting the exercise price and the premium. Meanwhile, for the stock purchase warrant, it costs 70 cents and has a much longer maturity than the call option, which is up to 2 years. At the same assumed share price of RM7, the potential profit is 10 per share, which is lower than the call option. So, overall, when we look at the table, the call option provides the higher profit but short-term exposure, while the warrant offers lower profit but a longer period to benefit from the future price increases. An investor who expecting short-term gains would prefer a call option because it requires a lower cost. It offers higher potential profit. And third, unlike stock purchase warrant, a call option is aligning with the investor expectation within 3-month timelines, as it offers short-term maturity period. Meanwhile, warrant or stock purchase warrant are better for long-term investor because they do not expire as quickly as call option and still appreciate over the time. Question 4D asks us to discuss one potential benefit and one risk associated using hybrid and derivative instruments such as convertible bonds, option, and warrant as a part of financing and investment strategy. This is from the perspective of the Emerald Berhad as the issuer and the investor itself. So finally, we took from the perspective of the issuer, which is Emerald Berhad. As an issuer, the benefit that Emerald Berhad will get is lower cost of financing. Emerald Berhad can issue lower cost of financing at lower interest rate, which is 4% compared to straight debt, because investor value conversion feature. The risk that they will face is dilution of ownership. If the bonds or warrants are converted and the new share is issued, the number of shares outstanding will be increased. As a result, the existing shareholder ownership and the earning per share will be diluted. From the investor perspective, the benefit they face is upside participation with limited downside. Hybrid and derivative instruments allow the investor to benefit from the share price while limiting losses to the initial investment. The risk that they will face is leverage and expiration risk. For option and warrant, if stock price does not exceed the end exercise before the expiration date, the investor will lose entirely 100% the investment made.
Set to question 1, we managed to find several key concepts including credit policy evaluation, the cash conversion cycle, dividend theories, and the residual dividend model. For part A, we will analyze whether or not Sabah should change its credit policy. The key concept here is incremental net profit. We are weighing the extra money coming in against the extra money going out. The procedures including calculating the profit from the new sales increase, and then we will calculate the new speed of payment, which is 0.4 times 10 days plus 0.6 times 45 days, which equals to 31 days. Next, we will calculate the cost of the 4% discount and the 2% administrative fee on the new total sales. Next, we will calculate how much 6% interest we save by reducing our receivables from 45 days down to 31 days. For the last part, we will subtract all the costs from the benefits. For the next part, which is part B, we look at why Sabah would offer a 4% discount in the first place. This is a strategy to improve the quality of the balance sheet. Some of the benefits Sabah would get for offering an early settlement discount, including encourage faster payment, which can lead to improvement in cash flow, reduce the risk of bad debt as it's shortening the collection period, and make the company appears more attractive than rival companies, which potentially increase customer loyalty. Finally, in part C, we calculate Sabah's cash conversion cycle. This is the ultimate test of how efficiently management is using their resources. The first step is to find the inventory days. Since the current receivable period is 45 days and the problem says this is twice the inventory period, we know inventory days is 22.5 days. Next, we will calculate the current CCC, which is by adding inventory and receivables and subtract the payable days, which equals to 37.5 days. Next is to calculate the new CCC. We are using the new average collection period, which is the 31 days we found in part A. We will plus with the new average inventory days, which is by dividing 31 days by 2, which equals to 15.5 days, and we will total the two up and subtract the APP, which is the 30 days, which equals to 16.5 days. By comparing the two CCCs, we find out that the company's cash is trapped for a much shorter time in the new CCC.
For question 2, the key concepts that we identified is residual dividend policy, payout ratio, Modigliani and Miller's dividend irrelevance theory, and bird in the hand theory. 4A, the question requires us to explain the dividend irrelevance theory and bird in the hands theory. First is the dividend irrelevance theory. Dividend irrelevance refers to the theory that investors are indifferent between dividends and capital gains, making dividend policy irrelevant to its effect on the firm's value. According to Miller and Modigliani, they assume a perfect market with no taxes, no flotation or transaction costs. They argued that when a company pays dividend, it reduces funds for growth, so the company must issue new shares to replace the money. When dividends are paid, the share price will fall by exactly the same amount, so shareholders don't gain anything extra. Thus, investors should not care whether they receive dividends or capital gains. The second one is bird in the hand theory. This theory says that the investors actually do care about the dividend. Gordon and Littner, who created this theory, argued that investors believe that getting cash in their hands right now is much safer than waiting for the stock price to go up in the future. So, companies that pay dividend higher are seen as less risky by the investors. Thus, firms with the high payout ratios would have higher values than those with the lower ones. 4B, the question requires us to discuss three main reasons why may dividend policy be relevant in the real world. The three main reasons why dividend policy may be relevant in the real world is the first one, risk consideration. In the real world, investors are generally risk averse. They prefer to receive current dividends rather than uncertain future capital gains. This is because they are more certain and less risky. So companies that pay dividends are often valued more highly by investors. Second is signaling effect. Dividend payments can act as a signal about the firm's future performance. A stable or increasing dividend shows that the company is doing well, while a lower dividend may signal problems. Thus, dividend policy can affect investors' perceptions and the firm's value. The third one is clientele effect. Different investors prefer different level of dividends. Some investors prefer high dividends for regular income, while others prefer lower dividends for tax reasons. Firms attract shareholders who match their dividend policy, making dividend policy important. For C, we need to use the residual dividend model to determine the total dividend and payout ratio of Tawakal Sendirian Berhad. The company has a capital budget of 800,000 and an optimal capital structure of 60% equity and 40% debt. To calculate the equity needed, 60% times with the 800,000, it amounted to 480,000 ringgit. Since 600,000 ringgit of earnings is available and only 480,000 is needed, the residual is 600,000 minus 480,000 equals to 120,000 ringgit. So 120,000 ringgit is the amount that should be paid out as dividends. The payout ratio would be 120,000 ringgit over 600,000 ringgit equals to 20% payout ratio. For D, based on information in question C, we need to explain what would happen if net profit is forecasted at 500,000 ringgit. Based on information in C, equity needed is 480,000 ringgit and available profit is 500,000 ringgit. To get the total dividend, 500,000 minus with 480,000 ringgit equal to 20,000 ringgit. The payout ratio would be 20,000 ringgit over 500,000 ringgit equals to 4%. Thus, if the net profit drops to 500,000 ringgit, the firm can still meet its equity financing needs, which is 480,000 ringgit. But only 20,000 ringgit remains to be distributed as dividend. As a result, dividend payment become much smaller and the payout ratio falls from 20% to 4%. For E, we need to explain one advantage and one disadvantage of residual dividend policy. One advantage of the residual dividend policy is that it reduces the financing cost. Instead of borrowing funds or issuing new shares, which involves flotation costs and interest expenses, The company uses its own profit to finance new projects first. By doing this, the company can focus on growing the business before distributing any leftover profits to shareholders. One of the disadvantages is the dividends are unpredictable. The dividend can be very inconsistent because dividends are only paid after all investment needs are met. The amount may change every year or may not be paid at all. This can be unattractive to investors who depend on regular dividend income. The uncertainty can also make the company's share price more unstable as investors are unsure what to expect.
The key concepts that we identified for question 3 are operating leverage, financial leverage, total leverage, financing decision, and Modigliani and Miller theory. For question A, we calculated the degree of operating leverage, the degree of financial leverage, and the degree of total leverage before expansion. So first, we calculated the degree of operating leverage. The formula for degree of operating leverage is sales minus variable cost divided by EBIT. So sales are 1,500,000 ringgit and variable costs are 450,000 ringgit. So the contribution is 1,050,000 ringgit and EBIT is 500,000 ringgit as given in the question. Therefore, the degree of operating leverage is 1,050,000 ringgit divided by 500,000 ringgit, which equals to 2.1. This means that a 1% change in sales will result in a 2.1% change in EBIT. Next, we calculated the degree of financial leverage. The formula for degree of financial leverage is EBIT divided by EBIT minus interest. So, EBIT is given in the question, 500,000 ringgit, and interest expense also given in the question, 100,000 ringgit. Therefore, the degree of financial leverage is 500,000 divided by 400,000, which equals to 1.25. So, this shows that a 1% change in EBIT will lead to a 1.25% change in earnings per share. The final calculation for question A is we calculated the degree of total leverage. So the formula for degree of total leverage is degree of operating leverage multiplied by degree of financial leverage. So therefore, the degree of total leverage is 2.10 multiplied by 1.25, which equals to 2.63. This indicates that a 1% change in sales will result in approximately a 2.63% change in earnings per share. So the firm faces moderate total risk before expansion. For question B, we constructed the income statements after expansion and calculated the earnings per share for both financing options. So after expansion, sales increased to 2.5 million ringgit and variable cost at 30% amount to 750,000 ringgit. So fixed cost increased to 850,000 ringgit, giving an EBIT of 900,000 ringgit. So under bond financing, the expansion is funded by bonds at an interest of 14% rate. So this creates additional interest of 56,000 ringgit, making a total interest at 156,000 ringgit. After tax, earnings are 446,400 ringgit with 100,000 shares outstanding, and their earnings per share are 4 ringgit and 46 cent. So under equity financing, no additional interest is incurred, so interest remains at 100,000 ringgit. So earnings after tax are 480,000 ringgit. However, the number of shares increases to 110,000, resulting in earnings per share of 4.36 ringgit. So this shows that bond financing gives a higher earnings per share even though the total profit is lower. For question C, we calculated the degree of operating leverage, the degree of financial leverage, and the degree of total leverage after expansion for both financing options. So first, we calculated the degree of operating leverage. The formula for degree of operating leverage, as I mentioned in question A, is contribution divided by EBIT. So after expansion, contribution is 1.75 million ringgit and EBIT is 900,000 ringgit. So therefore, the degree of operating leverage is 1.75 million ringgit divided by 900,000 ringgit, which equals to 1.94. This means that a 1% change in sales will result in a 1.94% change in EBIT. Next, under bond financing, the company has a total interest of 156,000 ringgit, which includes the 14% bond interest. The formula for degree of financial leverage is EBIT divided by EBIT minus interest. Therefore, the degree of financial leverage is 900,000 divided by 744,000, giving a value of 1.21. The degree of total leverage is calculated by multiplying the degree of operating leverage and the degree of financial leverage. So under bond financing, this gives 1.94 multiplied by 1.21, which equals to 2.35. This means that a 1% change in sales will result in a 2.35% change in earnings per share. Under equity financing, interest remains at 100,000 ringgit and the degree of financial leverage is 900,000 ringgit divided by 800,000 ringgit, which equals to 1.13. So the degree of total leverage is therefore 1.94 multiplied by 1.13, which equals to 2.19. So overall, bond financing results in higher financial and total leverage than equity financing, indicating higher overall risk but also greater sensitivity of earnings per share to changes in sales. For question D, bond financing is the preferred financing plan for busy Sdn Bhd. This is because debt financing does not dilute existing shareholders' ownership, allowing shareholders to fully benefit from higher profits after expansion. In addition, interest on bonds is deductible for tax purposes, which reduces the company's tax payments and increases the profit available to shareholders, resulting in higher earnings per share. However, bond financing also increases financial risk because interest payments must be made regardless of the company's performance. If sales do not increase as expected, profits and earnings per share will fall more sharply, and the company may face financial difficulties. In comparison, equity financing is safer because there are no fixed payment obligations, but it dilutes ownership and reduces earnings per share. Overall, bond financing is preferable provided that the expected increase in sales is achieved. For question E, Modigliani and Miller argue that under perfect capital market conditions and without taxes, a firm's capital structure does not affect its value. So the value of the firm depends only on its operating income and business risk, and not on the mix of debt and equity. As the level of debt increases, financial risk also increases. Because of this higher risk, equity holders require a higher return. This increase in the cost of equity offsets the benefit of using cheaper debt, resulting in the weighted average cost of capital remaining unchanged. When corporate taxes are considered, the conclusion changes. Interest on debt reduces tax payments, which increases the value of the firm. However, excessive use of debt increases the risk of financial distress. Therefore, in practice, firms aim for an optimal capital structure that balances the tax benefits of debt with that associated risk.
So for question for part A, the key concept is merger and acquisition valuation, where we value the target company, which in this question is Besi Sdn Bhd, and decide how much metal Bhd should pay. There is also information given, beta, which we know that beta is measure the risk, which higher beta means the investment is riskier. Other than that, capital asset pricing model, we calculate the required return on asset, which give the rate of future cash flows. Moreover, time value of money, where all future cash flows are discounted to present value. Next, net present value, where we calculate value of Besi Sdn Bhd to metal Bhd at the sum of present value of all cash flows. So the first step, we need to calculate the CAPM. So the info given is beta is equals to 1.2. The risk-free return is 6%. The market risk premium is 4%. So the market risk premium is market return is minus with the risk-free of return. So for the formula, required return on asset is equals to risk-free of return plus beta times with market return minus with the risk-free of return, or also known as market risk premium. So we input all the info, which is equals to 6% plus with 1.2 times with 4%. So the answer will be 0.108. So next step is we need to calculate the net present value. So the cash flow for the first year is 1.8 million. Second year is 2.2 million. Third year is 3 million. Fourth year is 4 million. And fifth year is 4 million. So the interest is 10.8%. So we insert all the info in the formula, which is CF0 is 0, CF1 is 1.8, CF2 is 2.2, CF3 is 3, CF4 is 4, CF5 is 4. And then the interest is 10.8%, and we will get net present value of this cash flow is 10.67 million. For the third step, we need to calculate the future value and the present value. We calculate future value by using FV is equal to CF divided by K minus G. So we input all the info where FV is equals to 4 times 1.05 divided by 0.108, which is the required return on asset, minus with 0.05, which is the growth rate. So we will get future value is 72,413,793. And after we get the future value, we need to find the present value. We will calculate present value using the financial calculator. So we input all the info, which future value is 72,413,793 and is 5 years. Interest is 10.8%. We will get present value is equals to 4,363,317. And after we get the PV, we need to add all value of present value, which is the step 4. We take the NPV, which is 10,670,000, plus with the present value we calculate just now, which is 43,363,317. So the value will be 54,333,317. That is the value of besi sedium berhad to metal berhad. So for part B, the key concept is firstly is the value of warrant. Warrant has both market value and theoretical value, and warrant premium, to calculate it, is the difference between the market value and theoretical value. Other than that, for profit or loss of the warrant, to calculate it, the value of warrant minus with the purchase price. This show whether exercising the warrant is financially beneficial to the company or not. Next is the rate of return, which measure how well the investment performed. So to solve this question, firstly we need to calculate the value of warrant. So the info given is the investment is 50 warrant, cost per warrant is 21 ringgit, market price is 40 ringgit per share, exercise price is 35 ringgit, and each warrant is 2 shares. So the value of warrant is current market price of share of common stock minus by the exercise price of the warrant times with the number of shares of common stock obtainable with one warrant. So we input all the info where 40 ringgit minus with 34 ringgit and times with 2, we get the value of warrant is 10 ringgit. Next step is we calculate the profit or loss. So the formula is total profit or loss is equals to the value of warrant minus with the purchase price times with the number of warrant. So 10 ringgit minus with 21 ringgit times with 50, and then we will get negative 550, which we will get loss. For the last step is we need to calculate the rate of return. The formula is net profit or loss divided by initial investment. That figure will be times with 100. So we get loss by the previous calculation, which is 550, and we will divide it by the initial investment, where 21 ringgit times with 50. And that figure we will times with 100, and the answer is negative 52.38%. For part C, the key concept is about convertible bonds, where a convertible bond is a hybrid security that can be converted into a fixed number of ordinary shares. There is conversion ratio, which shows how many shares each bond can be converted into, and to calculate the conversion value is equals to conversion ratio times with the share price, which represent the market value of shares received upon conversions. So for part CA, we need to calculate the conversion value. So the info given is call price is equals to 1,200, conversion ratio is 25 shares, the current share price is 40 ringgit per share. So the formula is conversion ratio times with the current share price, where is conversion ratio is 25 times with the current share price is 40 ringgit, and we will get conversion values 1,000 ringgit. So the bondholders will likely allow the bond to be called and accept the 1,200 payment. This is because the call price is higher than the conversion value, which is the conversion value is only 1,000 ringgit. If they convert, they will suffer loss for 200 ringgit. For our next question, part C, question B, we need to calculate if the bond outstanding for 4 years 11 months. The info given is the ratio is 25 before 5 years, ratio 20 after 5 years, ratio 17 after 10 years. So because of this question is 4 year 11 months, which is less than 5 years, the ratio that we will use is 25. So the formula of the bond price is equals to conversion ratio times with the share price. So the ratio that we will use is 25, and the share price is 41 ringgit. So the bond price is 1,025 ringgit Malaysia. Question for part C. Question C. We calculate if the value rise to 42 ringgit 75 cent in 3 months. So the timing will be 5 years 2 months. So the ratio that we will be used is 20 because it more than 5 years, and the anticipated price is 40 ringgit and 75 cent. So we calculate the bond price, where the conversion value that we will use is 20 times with the anticipated price is 42 ringgit and 75 cent. The bond price will be 875. So we calculate the difference if we convert the bond now or later after 5 years is 1,025 minus with the 875, the difference will be 150 ringgit. So the bondholder should convert now, which is less than 5 years, or they will get 150 ringgit loss. Although the anticipated price is increased, the conversion ratio drops significantly, which cause larger loss in total value. So that's all from our group. Thank you.